Visionary Investor Podcast. I'm your host, Andrew Marks, and I'm a stock market wealth investment mentor, speaker, and entrepreneur who has a passion for all things stock market investing, diving deep into quantitative and qualitative analysis, creating formulas and calculations that optimize stock market investing, and creating a life that fits your biggest and wildest dreams. You're in the right place if you're ready to tap into some investing strategies that aren't taught without getting a degree, working for an investment firm, and some that aren't even taught anywhere else in the world. Find deeper clarity on your investments and what your future can hold. Strengthen your understanding of recession, stocks, and your money, and learn the tools to accelerate your investments and wealth. You're here to be a visionary investor, not an average one. A passionate disruptor with uncommon goals in the investing world. It doesn't matter where you are in your investing journey. You're never too late to become a successful investor, and I'm here to help you do that. Let's get into the investing flow. So imagine you want to drive a car. What should be the first step you take? Should you just jump in a car and start trying to drive? Or instead, should you learn the concepts of what a car is, what it does, how it works, how to drive it, and then slowly start test driving it, maybe through student driving or with someone who's more experienced? The same thing applies to the stock market. When I hear people say you don't need to know what you're doing in order to invest, I really caution you to think twice about this. And that's the concern that I have with people just going to invest into index funds too, because that doesn't give them the ability to really figure out what they want to do with their investments, how it aligns with their goals, as we talked about on the last episode. So obviously, just like you're not going to just get in a car and start driving it, I don't believe you should just get into an investment and start investing. There are things to learn, and this episode is going to break down some of the foundations and basics for you. So first of all, what is the stock market? This is where investing happens. The stock market is a marketplace where securities like stocks are bought and sold. So essentially we have our buyers and we have our sellers. And the buyer and sellers are coming together to buy and sell shares of publicly traded companies. So what is a stock essentially? It's part ownership of a publicly traded company. So you're exchanging money to own a part of a publicly traded company. Now this can easily be done online through a brokerage, which is like a middle person that facilitates a transaction between buyers and sellers. And as an owner of stock, you get to share part of the profits if the company pays out something called a dividend. You also have capital gains, which means the stock price appreciating will make you money. So let's break this down a little further. A share is a unit of a stock. So for instance, let's say you own Apple stock. You could have 1 share, 10 shares, 100 shares. Essentially, it's that unit. There are different types of investing strategies out there. We're not going to go further into that in this episode, but essentially you could either make money through dividends, and that could be the bulk of the money you're making in the stock market, not caring as much about stock price movement, or through capital gains. So imagine you buy a stock at $10 and 2 years later, it goes up to $15. If you have 1 share, you've made $5 on that share. If you had 2 shares, you multiply the number of shares, 2 times the amount you made per share, which is $5. So if the stock goes from 10 to 15 and you have 2 shares of that stock, you've made a total of $10 profit. And that's considered your capital gains. Of course, that's going to be taxed. And this is when I'm talking about, and generally when most people are talking about their stock return, their gains, majority of it, generally speaking, and when you're talking about value investing and longer term, we're looking for price appreciation. We're looking for stock prices that are going to go up in the long run. Why do stock prices go up or down? Let's talk about the basics and why you really want to know what you're doing before you invest. So in order to understand stock price movement, I think we should talk a little bit about economics, macroeconomics and microeconomics. Macroeconomics, think of nationwide, large scale general economics. We're talking about interest rates, GDP, which is gross domestic product, national productivities, things on a national, US or whatever country you're referring to level. And then let's talk about microeconomics. This is more individual. We're looking granular here. So we're looking at how individuals or companies allocate their resources, production, exchange, and consumption. These are two obviously different topics, but they're also somewhat related. So when you're investing, you want to understand the broader scale of things. You want to understand what's going on in the overall stock market, what's going on in the overall economy, but then you also want to understand what's going on in this specific company. So if you're looking at Apple, what's going on that's either driving Apple to make more money and make a greater profit, or what's driving Apple to make less money and lower profit. At the end of the day, this all boils down to supply and demand, finding a balance, a market equilibrium. What's a supply and demand balance? What does this have to do with investing? Why are you talking so much about economics? If we think of the basics, even from a marketing perspective, from a business perspective, Apple wants to sell an iPhone, a computer. If they market the price way too high and the demand is very low at that price, they may have trouble finding that market equilibrium. But if they find a good price and they build, which they've done, a strong customer base, a strong brand, a strong strategy, people love their products, people are willing to pay at that price for that product. So here we see demand. So demand is the amount a consumer is willing and able to purchase. Supply, on the other hand, is the amount of good and service that is available for consumption. So imagine Apple only had the ability to make 10 computers, but the demand for it was hundreds of people wanted it. What would happen here? They'd have to increase their prices, and eventually they would come to a point where, you know what? Supply and demand are equal, and those 10 computers are able to be sold for a price that matches buyers and sellers. How buyers and sellers interact will determine transaction prices and quantities. Now, this same concept that we just talked about, supply and demand for Apple, is very similar to the supply and demand that we're going to see in the stock market. What the stock market's doing is, as I said in the beginning of the podcast, it's connecting buyers and sellers. So a buyer, someone who wants to buy stock; seller, someone who wants to sell stock. This essentially is the basis of the stock market. Why someone wants to buy a stock, they think the price is going to go up. Why someone wants to sell a stock, they think the price is going to go down. Essentially, where those two intersect, that market equilibrium, is a sale of a stock. So someone wants to buy a stock for $10, someone's willing to sell it for $10, we're going to have a match. And the stock market, essentially stock exchanges, work to match buyers and sellers of stock. Can you invest without knowing this? 100%. Do people invest without knowing this? 100%. Do I believe people should invest without knowing this? No. And the reason for this is, if you're unable to understand the basics of what drives a stock price, what drives the stock market, what are you investing into? It's just like going to try to drive a car without understanding how it works or how to drive it. What are you going to do? So if you're just relying on someone else, imagine trying to drive and you're relying on the person in the passenger seat to tell you what to do. Well, you're probably going to have a big problem, especially if you're not able to think on your own. Because what are you going to do when you either need to hit the brakes or step on the gas to prevent an accident, but you're listening to the person next to you? You're probably going to have a delay. Then you're going to try to think for yourself. It's too late. The same thing happens in the stock market. You want to be able to make decisions for yourself so that you can make the best decisions for your own stocks, your own goals. You want to understand this very well. If we talk a little bit more about the basics, when there's a higher price of a stock, for instance, that means that more people want to buy it. When there's a lower price, that means less people want to buy it. Another way to look at it is there's a low availability and a high demand, that is an increase in price. And vice versa, high availability and low demand, that's a decrease in price. So what's happening here? Imagine if when there's an increase in demand, more people want to buy the stock. And why do they want to buy it? There are essentially three different reasons that drive stock prices up or down. Number one, fundamentals of a company. So what's going on behind the scenes? How are the company's fundamentals, or essentially their financials? How strong is their management team? We're looking at these key concepts to see how well a company is performing. Number two, technicals. So we're looking at external conditions here. That could be inflation, that could be economic strength of management team and compared to its peers. That could be institutional buying and selling. Again, this is driven by economics. This could be a large or small trading volume. It could be momentum. A stock has just been really following this momentum train, and more people are like, oh my God, look at this stock. I got to buy it. It just keeps going up and up and up. Or this could be based on sentiment. So what's going on in the news? What's the market sentiment? And this here is something that causes stock prices over the short term to be so irrational, because people see the news, and if we look at the psychology behind investing and behind people making decisions, the social sciences behind it, that causes stock prices in the short term to go up or down. So a really basic example. Let's say there's an increase in demand to buy Apple stock because people really think the stock long term is going to rise because people see how strong Apple's brand is. And let's say Apple comes out with a new product and people love it and it's getting a lot of great traction. People are excited. They want more of this product. And what happens? Essentially, the price of Apple stock over the long term, if this actually proves to be increasing the company's revenues and their bottom line, their net income and their cash flow, it's actually helping the company grow. Well, that theoretically should help Apple stock rise. And if people envision and predict that this is going to increase Apple's earnings, the stock price will probably rise over the long term. Now, the opposite. Let's say Apple comes out with a new product. They spent a ton of money investing into this product, and the market, people in general, consumers, they don't like it. This is obviously going to cause a problem for Apple's revenue. It's going to cause a problem for their bottom line, their net income, their earnings, essentially. And as a result of this, people are going to start feeling that Apple, over the longer run, their stock price is too high. People are not going to want to continue to buy the stock. Instead, people are going to want to sell the stock. So the demand has decreased. The stock price over the long term could decline. See how everything's related back to supply and demand? More people want it. Over the long run, the price is going to go up. Less people want it. Over the long run, the price is going to go down. What is the ultimate driver behind this in the long run? The ultimate driver is based on supply and demand because it's based on the fundamentals. Now, if you don't know this, you'll be really confused to see all of the price changes that happen day to day, month to month in the stock market. They really can discourage you because so much happens. And without understanding that a lot of this really is so short term and it's based on irrational thinking, it's based on illogical thinking. A basic example, for instance, is someone could have a theory out there based on some news that came out that they believe Apple stock is just going to really crash. And as a result of it, they sell their stock, or they can even do something called trying to short the stock. They don't believe in it, so they're betting against it. This literally could be based on news that just came out. Over the long run, if Apple's stock continues to do really well, and this person's theory or this company's theory was just completely wrong because the company is doing really, really well, well, then obviously what's going on here is Apple stock is going to rise over the long run because it's based on the fundamentals. But if you're just looking at investing from a day-to-day perspective, it's going to be near impossible to see this. And I see this happening to so many investors. And that's why people are always so confused, because they're looking at things from a short-term perspective. We want to zoom in for certain information and zoom out for other information. Not knowing when to do the zooming in and the zooming out will cause a lot of difficulty as an investor. If you don't know what you're doing and you're trying to invest, what are you really doing? Like I've said, would you go drive a car without knowing how? Why would you then go invest without knowing how? What are you relying on then? You're relying on other people's information. You're not creating your own ethics, your own beliefs, your own goals, your own visions around the stock market yourself. And this is just setting you up to fail, because how are you going to know Should I buy more of whatever the investment is? Should I hold it? Should I sell it? If you're just investing based on other information out there, sure, you could do well, you could get lucky, but you don't really understand the basics, the foundation, what's really going on here. Why is a stock price going up or down? What is that based on? What do I do to find out whether I think that stock price is going to go up or go down? These are really key factors that you want to understand really well, and it all boils down to that supply and the demand, that market equilibrium, that balance. Over the long run, as I've said, the fundamentals of the company are going to drive that stock price. So for instance, 2010, Apple's here, 2023, Apple's all the way up here. There were a lot of up and downs throughout. The cycle, of course, has been up, but there were so many up and downs that happened based on short-term patterns, based on a lot of illogical, irrational human behavior, as I shared the story before. So you have to learn how to avoid this noise, but you have to learn how to understand what's going on here. And if you don't, it's so easy to become emotional when you're investing and just sell a stock because you feel like, oh no, what's going on? And a big, big thing that happens is when people don't know how to invest around a recession or even really know much about a recession, because generally a recession, which is an economic downturn, an NBER, which is the organization that defines and actually declares a recession, defines it this way: a significant decline in economic activity that's spread across the economy and lasts more than a few months. So why am I talking about this? I've done a lot of research on recessions, and I noticed there's a common pattern that happens in the stock market. Going into the recession, whether the stock market rises or falls going into the recession, once the recession starts, the stock market as a whole falls pretty drastically normally, but we haven't seen, especially looking at the past 8 recessions, and if you go back in history, you probably see the same thing happen. We haven't seen, all right, the economy is in a recession and the stock market is it's off to the races and it's continuing to go up and it continues to go up. When we hit a recession, stock market falls. Over the long run, will it rise again? Yes, it always has, because people have confidence in the stock market. There are so many factors that impact whether we're going into a recession or not, but it again boils down to supply and demand. I want you to learn what you're doing before investing so that you can make smart decisions and you understand what's going on. Don't just drive a car without knowing how. The same applies to investing. Don't just go invest without knowing how. I want you to understand this really, really well, because this is going to help you grow your wealth and make more money and feel confident doing it, rather than just being confused, hoping things are going to go up. And then when they don't, you really will panic. Imagine having $1,000 or $10,000, even $1 million. And all of a sudden you're down 20% because we hit a recession. Now you have $800,000. You don't understand what's going on and you sell. You sell everything you own, all the investments. Was this a smart decision? Now, obviously that fully depends, but probably not, because you were influenced by outside factors because you didn't really know what was going on. If you knew the patterns of recessions and saw that over the long run, the stock market rose again over time, that $800,000 in a couple of years could be 1.2 million, 1.5 million. But without the knowledge, how are you going to know? So whenever I hear from someone saying you don't need to know what you're doing to go invest, whether that's to go invest into just a standard ETF or index fund, whatever that is, I don't believe it. I think you should know. You should have the knowledge. It's something that frankly should be taught in school. Everyone should know this, because this gives you the ability to grow your wealth in a way that is so impactful. You can make your money work for you. We're not going to go into compound interest here, but what happens when you grow your wealth through the stock market? You're earning money on top of the money you've already earned. You see exponential growth in your wealth over time. Thanks for listening, and don't forget, subscribe to the podcast, leave us a kind review, and follow us on all other social media platforms at The Visionary Investor.